In this Excel assignment, we're going to build a worksheet that calculates our financial break-even. And our financial break-even is the point where our net present value exactly equals 0. In other words, we've just exactly earned, in this case, our 16% required rate of return. And in this worksheet, the item that we're going to be concerned about changing will be our financial bid price. What bid price do we need to have to achieve this financial break-even? Let's go ahead and build our worksheet out. First thing we're going to do is pick up our units sold equals, that's our 150, and we want to always come to that cell, so we want an absolute cell reference, so we need a dollar sign in front of both the B and the 4. Our bid price, we're going to begin with, we don't know what it's going to end up being, but for now it's a $12 a unit bid price. And again, we're always going to want to come back to that cell, so we put a dollar sign in front of both the B and the 3 for an absolute cell reference. Our revenue is simply going to be the bid price times the number of units. Our variable production cost will be our 150,000 units times a variable cost per unit of 850. And again, we're always going to want to come back to that cell, so we want to anchor that B5 with dollar signs from both the B and the 5. Fixed production cost, we're told, are 240. Again, make that an absolute cell reference. Our depreciation expense is going to be equal to our assets cost, the equipment cost of 780,000 spread over its 5-year life. So we're going to take our 780. Again, we want that to be an absolute cell reference, so dollar signs in front of the G and the 3 divided by 5 years. And again, we want an absolute cell reference. So now we've got our depreciation expense, and our taxable income is simply our revenue minus our variable cost minus our fixed production cost minus our depreciation expense. So it looks like this would generate, with a $12 bid price, taxable income of $129,000 per year. Our income taxes is our taxable income of $129 times the quantity times our 35% tax rate. And we want to keep coming back to there, so anchor that with absolute cell references, our tax rate. Our net income then is the 129 minus the 45, and we've got net income of 83,850. To estimate our operating cash flows for our projects, and we're going to get into this in our chapter on cash flows, but a quick and dirty estimate is to simply take our net income and add back our depreciation expense, and we've just calculated that as 156. So our operating cash flow that we're going to estimate will be net income, add back our depreciation expense. And so we expect this project to generate $239,850 in operating cash flow every year for, and we can just copy that across, 5 years. Okay. And again, notice as we change the bid price, our operating cash flows change accordingly. Let's go ahead now and pick up our salvage value. We expect an after-tax salvage of 50,000. That's a cash inflow. We had a working capital requirements, we're told, and that's a cash outflow of 75,000 at the beginning of the project. And remember, we always have that release or recover that working capital at the end of the project when we sell off our inventories and collect all of our accounts receivable. And our equipment was going to cost us $780,000. So finally, we've got all of our cash flows, and we can just sum those up for each year. Equals sum. And I'm going to highlight rows 27 through 31 so I can have a formula that I can copy across to all of my years. Now that I've picked up or estimated my cash flows for each year, I simply need to find the present value of them. And remember, that's simply equal to the future value divided by the quantity, 1 plus our required rate of return, 16%. We want to make sure we anchor that because we're always coming back to it. And that's going to be to the, how many years do we need to discount it back? The time 0 cash flows will discount back for 0 periods. And our 855 has a present value of negative 855. And I can copy that formula across because look, we can go out here and we can see that in the 5th year, I'm discounting it back at the 16% rate of interest because I anchored that with the dollar sign in front of the B and the 9. And since I referenced this year up here as I copied across, now it's the 5th year. I can check and see, sure enough, the year 4 cash flow, I've discounted back 4 periods. The year 3 cash flow, I've discounted back 3 periods. So now I can sum those up, equal sum, and again add up the present values. And we can see that at a bid price of $14 per unit, our project has a positive net present value of $628,341. We can also calculate the internal rate of return with Excel. It's very easy. Equals IRR, parenthesis, and then we simply just highlight the cash flows, not the present values, but the cash flows. And I've got a 43.6% internal rate of return. We wanted to know what bid price will give us a net present value of 0. We could come up here and change it. 14 had a positive net present value. Let's try 13. That took us down to 309. How about a $12 bid price? $12 bid price takes us down. Oh, that's a negative net present value, so that's a bit too low. We could continue to guess like that, or we can use Excel's goal seek function, which is really very easy to use. We want to set this net present value cell B36, equal to 0 by changing cell B3. And recall B3 was where our bid price was. So to use goal seek, data, what if, goal seek, and again we want to set cell B36 to 0 by changing the bid price. And a bid price of $12.32 will do that for us, or $12.03. We could have also picked a different one. We could have said data, what if, goal seek, how much would we need to set our net present value? Let's say we wanted to have a net present value of $10,000. And again, by changing the bid price. And we can see we would need basically $12.06 to achieve that net present value. Now notice at that $12.03, where our net present value is 0, our project has an IRR of 16%. We've just earned our required rate of return. If we had a bid price lower, our net present value is negative and our return is only 15%, which is lower than our required rate of return. Anything above that break-even bid price, and we have a positive net present value, and the project will provide an internal rate of return slightly higher than our required rate of return. So again, let's just get that back to our net present value of 0. The next thing we're going to do, we might want to know how would changing our bid price over a range of potential prices impact our net present value or IRR? How would changing the unit cell impact our net present value or internal rate of return? How would changing our variable cost or equipment cost also impact these items? We can find and answer these questions by using data tables. And to put together a data table, it's really quite simple. At the top of our data table, we need to pick up the items we're interested in. And I've already done that on this one. So equals, we want to know the net present value. And we also want to know, in this case, say the IRR. Okay? So we've put those at the top of our table. Then we're going to highlight the cells that we are include the inputs we want to know about these bid prices. We want to calculate these values. So notice the cells that I've highlighted. Then we're going to go up to data, what if, data tables. Now our data tables are in the form of columns. They're set up in columns. We want the column input cell. We want to put these bid prices right up here in cell B3. And if we were to substitute each one of these bid prices in, we can observe its impact on the net present value. And again, right here at the $12 was when we just had a slightly negative net present value, and as we go above that, we have a positive net present value. Let's go ahead and look at the same thing. How would changing units, our number of units that we sold, impact our net present value and IRR? So equals, pick up that net present value cell, pick up the IRR cell, highlight those ranges, go up to data, what if, data table, and again, columns. These numbers are in a column, and we want to put the units right there in cell B4. And at a bid price that we currently have of $12.03, this is how changing our unit sales would impact our net present value and IRR. Again, notice as sales go up, the project makes more sense, has a positive net present value. Below that current level of sales, the net present value would be negative. Let's see how changing our variable cost would impact us. Again, equals net present value equals IRR. We come down, highlight those cells. That includes, again, the IRR and the NPV up top. Data, what if, data tables. Our tables, again, in the form of a column. We want to put these variable cost values in for the variable cost per unit. And we can see how changing that variable cost would impact our net present value and IRR. As our cost goes up, as to be expected, our net present value goes down. And finally, we can do the same thing with our equipment. Highlight data, what if, data table. Let's change our equipment cost from $780 to whatever we have in our table. And we can see as we would pay more for our equipment, that makes the project make less sense. If we could buy that same equipment for less money, then the project makes more sense. It has a positive net present value.